Hey everyone, welcome to The Explainer. So today we're diving into what I think is a truly fascinating corporate mystery unfolding right now in 2026. We're looking at one of the absolute most recognizable brands on the planet, McDonald's. Now, if you've been following the markets, you already know the golden arches had been under some serious, heavy pressure lately. But why? How does a global behemoth just suddenly stumble? And maybe more importantly, how exactly do they plan to get back up? We're going to unpack the whole shebang, the charts, the strategy, the missteps, and that recovery plan step by step. So let's get started.
All right, let's dive right in. Here's our roadmap for today. First, the golden arches stumble. Then we'll look beneath the financials, unpack the value menu misfire, review the turnaround blueprint, weigh the bull versus bear debate, and finally, check out the catalysts to watch.
Okay, part 1. The golden arches stumble. Let's chart this correction.
Just take a look at this number for a second. $341. Back in early 2026, McDonald's was flying incredibly high. I mean, if you had this in your portfolio, it felt totally invincible, right? Cemented as this core compounder. And this peak is absolutely crucial for us to look at because it establishes our baseline. It shows us just how tall the giant was standing before gravity and, well, some major operational challenges took over.
But man, contrast that peak with where we are today. The stock is now in a very clear, undeniable correction phase, struggling right near the absolute bottom of its 52-week range. It's a stark reversal of fortune, and it's one that has caught a lot of the market completely off guard.
So, looking at the technical damage, support is currently holding near that 260 level, which lines up with that 52-week low we just talked about. On the upside, the next short-term hurdle is the 281 to 288 resistance zone. But here's the kicker. The long-term trend line, that 200-week moving average at roughly 288, has been broken. That's a major signal of a trend reversal. Now, while the daily RSI is sitting in neutral territory at 49 and the MACD is definitely showing bearish momentum, there is a tiny glimmer of hope. Weekly slow stochastics are in oversold territory and actually turning upward, which suggests that this heavy selling pressure might finally be easing up in the medium term.
Moving on to part 2, beneath the financials. It's really a tale of two margins.
On the surface, things actually look surprisingly good. Look at Q1 2026. Global top-line sales growth was positive and honestly incredibly consistent across the board. The US grew by 3.9%, holding on to its market share. The international operated markets, so we're talking the UK, Germany, Australia, they also grew by 3.9%. Even the developmental license markets, led by Japan, grew a really solid 3.4%. So from the outside, the engine seems to be humming perfectly.
But, and this is a big but, you juxtapose that solid sales data with this literal admission directly from McDonald's management. They stated, point blank on their earnings call, that U.S. company-operated restaurant margins are not acceptable. Think about that for a second. Sales are up nearly 4%, but the profitability of the stores the corporate office actually runs is actively deteriorating. This is a massive red flag, because if the parent company can't run its own stores profitably, something is fundamentally broken at the operational level. And that brings us to the crux of the issue, this fundamental disconnect. The CEO openly noted that franchisees, the independent business owners who run the vast majority of McDonald's locations, are earning significantly better margins on their restaurants than the corporate-run locations are. It's literally a tale of two margins. The franchise owners are figuring out how to navigate a tough economy, while corporate is, by their own admission, dropping the ball in their own kitchens. Which leads us right into part 3, the value menu misfire, and those big execution challenges. So how exactly did we get here? Well, the root cause of this operational slump, and the technical damage we looked at earlier, ties directly back to a highly criticized strategic rollout back in mid-April. It all started with EDAP, which stands for Everyday Affordable Price. It's basically a strategy designed to drive foot traffic using consistent, lower-tier pricing instead of constantly rotating promotions. So, mid-April rolls around, and McDonald's launches their revamped McValue platform built entirely on this EDAP model. We're talking about a true under $3 menu featuring things like the $2.50 McDouble and the $1.50 Sausage McMuffin. The whole goal was to aggressively win back that budget-conscious consumer. But as management later admitted, this strategy resulted in what they called a bad trade. Actually, it's more like a domino effect. Let's trace it. First, they launched that under $3 EDAP menu. But to fund those super cheap items, step 2 happens, they significantly reduced digital offers and outright eliminated a wildly popular buy one get one program that their heavy loyal customers absolutely loved. Step 3, boom. A full 1/3 of franchisees basically rebelled. They looked at the margins and refused to follow the recommended EDAP pricing guidelines. So what happens in step 4? The loyalists, those heavy users who relied on the app and the BOGO deals, effectively ended up paying higher prices. You alienated your absolute best customers just to launch a value menu that a third of your stores wouldn't even participate in. No wonder U.S. comparable sales turned slightly negative by July.
All right, let's look at part 4, the turnaround blueprint. Here's management's 3-part plan.
We know the problem, so let's pivot to the solution. Management has mapped out a timeline and a blueprint to fix this operational bleed, and it has 3 main pillars. First up, an immediate focus on operational improvements to clean up restaurant-level execution and actually give crews more support. The good news? This is entirely within corporate's control. Second, a massive marketing program reset. Now, because marketing calendars are locked way in advance, meaningful changes here won't really hit until Q4 2026, with a full reset targeted for 2027. But they're reallocating dollars back to proven value components and, thankfully, restoring those crucial digital offers. Third, and for sure the most important, value strategy alignment with franchisees. Management is actively using their business evaluation process right now to show underperforming non-compliant franchisees the performance gap and basically force them back in line.
And amidst all of this, they're still sticking to this massive long-term goal, reaching 50,000 restaurants by the end of 2027. But there is a totally fascinating caveat attached to it. They are seriously considering refranchising their underperforming corporate stores. Meaning, if corporate can't fix their own unacceptable margins, they're just going to sell those locations off to the franchisees who actually know how to run them profitably. Honestly, it's a pretty clever way to immediately improve their earnings quality. Part 5, the bull versus bear debate. Let's weigh the verdict.
So with the stock battered but a turnaround plan clearly in place, we are definitely at a crossroads here. Now, what's really interesting is that the foundation of the bull case rests on one massive structural advantage. 95% of McDonald's restaurants are franchised. Only 5% are corporate-owned. This exceptional asset-light model generates massive, hyper-consistent royalty income and incredibly strong cash flows, which keeps them almost entirely insulated from the day-to-day margin squeeze of, actually running a kitchen.
So, laying the two sides of the argument side by side, it's a stark contrast. The bulls, they see a core compounder trading near 52-week lows, way below its 200-week moving average, offering what they think is a prime long-term entry point. They're looking at a 2.8% dividend yield backed by over 50 years of continuous dividend hikes, all driven by that asset-light royalty model. The bears, on the other hand, see severely broken long-term technical trends. They see a sluggish U.S. market, which is, let's be real, their most important market, weighed down by very real execution issues and deeply alienated brand loyalists. And they know for a fact that getting stubborn independent franchisees aligned on a unified value strategy is a very, very slow and complex process.
Finally, Part 6, Catalysts to Watch. Here is the timeline ahead.
If you're tracking this corporate drama, and you definitely should be, here is the exact timeline you need to watch. It all kicks off with the September 2026 franchise meetings. Any signs whatsoever that corporate and franchisees are finally aligning on value will be a huge positive signal. And that alignment directly impacts our next milestone, Q3 2026 U.S. sales data. Remember, July was slightly negative, right? So we really need to see improvement in August and September to prove this turnaround is actually taking hold. That then flows into Q4 2026 when the new marketing program changes finally go live and restore those digital offers. And all of this culminates in 2027 with their Investor Day, where management promises a crystal clear value strategy and major updates on that 50,000 store goal. Which leaves us with this big provocative question. Will the Golden Arches regain their shine, or is the fast food landscape forever changed? Management completely expects momentum to recover by late 2026, but let's be honest, the ultimate success of this entire turnaround relies entirely on getting thousands of independent franchisees completely aligned. It's a massive puzzle. Thank you so much for joining me on this explainer today. Keep a close eye on those September meetings, and as always, stay curious.